Most people think you can only buy shares of a company after it becomes famous on the stock market. They wait until the company is already everywhere, already on the news, already expensive, and already making early investors rich. The pre-IPO strategy means buying small pieces of a company before it becomes public on the stock market. This means getting in early while the company is still growing quietly. Imagine a small online bookstore in the 1990s, before people knew it would become Amazon. Early investors bought small ownership pieces when the company was still tiny. Later, when millions of people started using it, the value exploded. It works like planting a mango seed before it becomes a giant tree. Most poor and middle-class people only see the tree after the fruits are already expensive. Rich people look for the seed first. Today, regular people can sometimes invest early using startup investing apps, crowdfunding websites, venture funds, or private investing platforms that allow smaller investments. Step 1 is learning where these companies are found. Step 2 is studying what problem the company solves. Step 3 is investing only small amounts you can afford to leave alone for years. The reason this works is simple. Small companies can grow much faster than giant companies. If a company grows from tiny to huge, early shares can multiply many times. The benefit is massive long-term growth instead of small, slow gains. The first beginner action is learning how to spot a company before everyone talks about it. Start by paying attention to things normal people suddenly begin using more and more. Maybe your friends all start using one delivery app. Maybe students suddenly use one study tool. Maybe small businesses start using one payment system everywhere. Step 1 is writing down products or apps you notice growing fast in daily life. This is simple because you are just observing people around you, like watching which food stand suddenly gets long lines every day. Step 2 is searching who owns that company and whether they are still private. Some companies are not yet on the stock market. Step 3 is checking if regular people can invest through crowdfunding platforms or startup investment websites. Imagine a delivery company in one city. At first, only 100 people use it. 1 year later, every restaurant uses it. Early investors noticed the growth before television news talked about it. This matters because money usually grows the most before the crowd arrives. If you wait until everyone is excited, prices are already high. If you learn to notice growth early, you gain the chance to buy before the big jump happens. That can mean turning a few $100s into thousands over many years instead of chasing already expensive stocks later. The second strategy is understanding that not every small company becomes successful. This is where normal people make mistakes. Many beginners hear exciting stories and throw all their savings into one company because they dream about becoming rich fast. That is dangerous. Smart investors spread small amounts across several companies instead of betting everything on one idea. Imagine you have $500. Instead of putting all $500 into one startup, a smarter move could be putting $100 into 5 different growing companies. One may fail, another may stay small, but one successful company can sometimes grow enough to cover all the losses. This works like planting many seeds because not every seed becomes a strong tree. A real-life example is people who invested early into companies like Uber or Airbnb before they became giant public companies. Some investors lost money in failed startups, but one huge winner changed everything. The reason you should do this carefully is because small companies are risky. If you ignore risk and put all your money into one company, you can lose everything. But if you spread your money slowly and patiently, you give yourself more chances to catch one big winner. The benefit is controlled risk with possible huge upside instead of gambling blindly. Smart people also study the people running the company, not just the product. A company can have a great idea but terrible leadership. Step 1 is checking whether the founders truly understand the problem they are solving. Step 2 is looking at whether customers actually use the product repeatedly. Step 3 is seeing if the company keeps growing each year instead of slowing down. Imagine 2 small food businesses. One owner listens carefully to customers, improves recipes, delivers fast, and manages money carefully. The other owner wastes money, ignores complaints, and keeps changing direction. Even if both started with the same idea, one survives while the other collapses. Smart investors study behavior before investing. They ask simple questions. Are more people using this every month? Does this solve a real problem? Would I personally use this product? This gives advantage because good leadership and real customer demand are what turns small businesses into giant companies. People who ignore these signs often invest based only on hype and excitement. They end up losing money because they followed emotions instead of observing reality. The gain from smart decisions is avoiding bad investments while increasing the chance of finding companies with strong future growth. Imagine a middle-class worker named Daniel making $3,500 a month in the United States. Every payday, he spends most of his money on fast food, gadgets, and car upgrades. After 5 years, he has almost no savings. One day, he learns about pre-IPO investing. Instead of wasting $300 monthly on things losing value, he starts putting $50 into different startup opportunities every month through legal investment platforms. At first, nothing exciting happens. Some companies fail completely. One small company barely grows. But Daniel keeps learning. He studies products people actually use daily. He notices a healthcare app growing in small clinics. He notices a business software company expanding quickly among restaurants. Over several years, one company becomes extremely successful and eventually joins the stock market publicly. Suddenly, his early shares become worth many times more than what he paid. Before, Daniel only spent money on things that became worthless later. After changing his behavior, he slowly built ownership in growing businesses. The result changed because ownership grows while spending disappears. His daily decisions slowly moved him from consumer thinking into investor thinking. What most people understand now is that wealth is often built quietly before the public notices. Rich investors are not always smarter because of magic secrets. Many simply enter earlier, stay patient longer, and understand ownership better. Poor and middle-class people are usually trained to work for money, spend money, and repeat the cycle forever. Pre-IPO investing teaches a different way of thinking. Instead of only buying products, you learn to own small pieces of the companies making those products. Instead of chasing hype after prices explode, you learn to observe growth early while things still look small and boring. The money system rewards ownership more than labor over long periods of time. A person who only spends money stays trapped buying things forever. A person who slowly builds ownership in growing businesses gives themselves a chance to grow with the economy itself.